This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. The value of a stock is not arbitrary, at least no more or less than the value of your house or your car. While the price will experience swings around popular opinion and investor sentiment, the value is grounded by future cash flows. If an asset is generating cash, those future cash flows are worth something. If the future cash flows are growing or exceed expectations, the value goes up. Of course, the opposite is also true. If cash flows decline or the expected future cash flows decline, the asset will be worth less. Without getting too into the vagaries of accounting, earnings are a reliable proxy for corporate cash flows. Earnings and the expectation of future earnings are critical to determining the value of a stock. It's fair to ask then, with a weakening outlook for the U.S. economy, largely due to rising interest rates to fight inflation, shouldn't we expect a negative outlook for the stock market this year? Stock market participants, investors, are always looking as far ahead as possible to determine whether future earnings are going to exceed or fail to meet expectations. Think of betting on the Super Bowl. If you pick the correct team to win on week 1 at the very start of the season, the odds will be considerably higher, your payout will be a lot more than if you pick one of the two teams that make it to the Super Bowl the week before the game. A lot can happen during the season. There is a good chance that even a favorite team to win at the start of the season won't even make it to the big game. The more uncertain the outlook, the more volatile the market will be. As data comes in, future earnings are better assessed and prices coalesce around the revised expectation. So the significant decline in stock prices last year was in expectation that earnings would be weaker this year. The price of stocks are already discounting an economically weak year for 2023. Here's a chart of the historical earnings and value of the S&P 500. Corporate earnings declined nearly 5% in 2022 over 2021, and the S&P 500 index lost nearly 20% of its value. Earnings for 2023 is an estimate and subject to revision as the year progresses. We think the forecast may be somewhat optimistic, but current analyst estimates are calling for 12% growth over last year. The point is, last year's sell-off was in anticipation of a weakening economy. The damage is largely done. Sure, stocks can go down more if the outlook worsens, but investors are looking ahead to 2024 already. This year, we're seeing greater corporate fiscal discipline, headcount reductions, layoffs, less aggressive investment in uncertain projects, which will improve margins long term. Consumers are generally in good shape. Unemployment is low and household income is good. A recession will be mild. Profits are likely to accelerate going into next year. Coming out of a recession, even a mild one, profits accelerate. If this forecast is close to the mark, stocks will also move higher. It does pay to be early. To sell now, as we move through what is expected to be a mediocre first half of the year, economically speaking, would be too late. It is worthwhile to take a moment to understand why the economy is weaker now, so we can have some perspective why we think things can improve as the year progresses. As usual, reality is a bit more complicated, but with the benefit of hindsight, it's apparent that the massive stimulus injected into the economy during the pandemic, coupled with supply chain disruptions and pent-up demand from consumers stuck at home, created a perfect storm. Demand has sharply outstripped supply, causing most significant inflation in the U.S. in 40 years. Here's a chart of the inflation rate in yellow plotted with the yield of the 10-year Treasury bond in blue. The Federal Reserve has what's referred to as a dual mandate. They aim for maximum employment, make sure people have jobs, and keep prices stable, keep inflation as low as possible. To return the balance of supply and demand, to reduce inflation, and to keep prices stable, interest rates have been rising fast. You can see the 10-year Treasury rate going from 0.5% to more than 4% at the end of last year. Unemployment is as low as it's ever been. Only 3.4% of the workforce is out of work and looking for a job. We expect unemployment to move a bit higher due to the weakening economy, but so far it hasn't really happened. With plenty of jobs, the Federal Reserve can keep hiking rates to fight inflation, but we think we're close to the end of the cycle. Inflation is declining. The rate of increases in interest rates has slowed, and the market is discounting that there may be only a half point further to increase before the end of the year. The outlook then is for a reacceleration in growth later this year into 2024. So I want to take a moment to talk about bonds. Bonds or fixed income assets are not talked about a lot. They don't capture the imagination quite like investing in stocks. Maybe they're boring or poorly understood, or it may be because they're more difficult to buy and sell. Over the last 15 years, the return on bonds has been 1/3 of that of stocks. Usually, the performance of bonds is better than that relative to stocks, but 2022 was a particularly bad year for bonds. There have been long periods where bonds have outperformed stocks, such as 2001 to 2011. It would be a mistake to discount the value of bonds completely. Fixed income assets are less volatile and provide a greater level of predictability in a portfolio than most other asset classes. Essentially, they reduce risk, but not last year. The rapid rise in interest rates, not just in the US, but globally, created a terrible environment for bonds. Here's a chart of the annual performance of the US Aggregate Bond Index since 1976. In the last 45 years, bonds have declined in only 5 years. And in none of those periods did the index decline more than 3%. Last year, the index fell 13%, easily the worst performance in more than a century. We think inflation is coming down and will come under control. We don't believe interest rates, at least short-term interest rates, will climb much higher. Going into this year, firm-wide, we had only 22% of assets under management in fixed income. With high-yield corporate bonds now yielding more than 6%, we are carefully increasing our exposure to bonds. We're also increasing investment in short-term government treasury bonds rather than holding on to cash. 2-year treasuries are paying more than 4.5%. That's considerably more than 1% or less than 1% in a money market account. If the stock market does remain weaker than we expect, an increase in fixed income will reduce volatility and produce some gains in portfolios. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.